Is the stock market overvalued? Are we set up to go into a recession? Or is this the next leg up in the overall stock market and we're going to start going back to good times? Those are the questions that we're wrestling through right now. And what we want to be doing is talking through the data, what we're seeing, and how that's going to be most likely playing out with not only the stock market, but how that can play out in your overall wealth plan. We have a lot to get to today, so we want to get started. Now, we are going to be talking about a number of different aspects when it pertains to the economy and expectations. So when we take a look at the economy, we need to know if we're going to go into a recession. So we're going to start taking a look at the recession to come. We're going to start taking a look at the volatility that is out there in the stock market. We're going to follow that up with earnings, and then we're going to be talking about any stock market moves that will be coming and the expectations for those. Then we will wrap it up with 2000 to 2002, the differences that we're seeing today versus then, and how that's going to impact the future of not only your investments, but overall wealth plan. Okay, let's start talking about recessions. Now, recessions are a tricky business because obviously they have a lot of impact for where we're going with the economy and the thought process behind them, but it also comes down to how do we predict where we're going with the economy as part of a recession. So when we take a look at the data, there is some data that confirms recessions. Now, historically, we have looked at 2 negative quarters of our GDP for our economy. Not only our economy, but economies around the world. And what we see is that most of the time that predicts that we are in a recession. Now, there are some few obvious outliers, and what we have just seen is the fact that we've had a negative quarter over quarter print for some of 2022, but we had a really actually good amount of growth happening in the last part of 2022, the fourth quarter. But what does that mean to come? Does that mean we are not in a recession? Or does that mean that a recession is to come? You see, these are the things that it really doesn't predict well. So we take a look at some other data points that are out there, and we start taking a look at what we call credit spreads, the differences between 2 years and 10 years, or 3 months and 10 years, all these different pieces of the puzzle that are out there. And most of the time, they predict where we're headed. So right now, we have what's called an inverted curve. What that means is that the 2-year yields for bonds are actually higher than the 10-year yields for bonds. Now, why this is important is because of the fact that the expectations of what's to come is that we have higher rates. And so you can actually earn more in interest buying a short-term bond than a long-term bond. Well, that's actually very telling for the state of our economy. You see, normally is actually you can get paid a greater amount of interest going into longer term bonds. So this actually has some very big implications to where we're headed. And this actually does suggest a recession. But again, we want to take a look at all of the other data points out there. And one of the biggest data points that we have is through the National Bureau of Economic Research, NBER. And what they talk about is the fact that they look at basically the world's worth of data points and come up with some predictors if we are in a recession or going into a recession. Now, the worst part about the National Bureau of Economic Research is that they are just a little late. A lot of times they predict a recession usually 6 months after we're already in a recession. So we want to take a look at what we call leading indicators and to really take a look at where we're at. So if we pull up a lot of the leading indicators of today, we are actually going to be starting with one that is related again to that credit, to the bond market, and to where we're seeing a lot of the companies. So not just bonds from the Treasury Department, but bonds from companies going. And what that looks like is that we take a look at the global credit is starting to slow incredibly fast. And what that looks like is that usually starts to precede a recession. So if that is the case, we start looking at this of when it starts, again, slowing down and rolling over. And it does point to the fact that we will be in a recession by April to May of 2023. So we know that at least this is a leading indicator that is showing that we are coming into a recession very quickly. And the severity that it actually is showing right now is that we're going to have a bad recession. So again, this is all data points and just thought processes. So it's not accurate as to the predictor of saying how bad or how good the recession is going to be, if we can use the term good for a recession, but it just is a thought process that we go through. Then we take a look at a lot of the other aspects here. So we go into what we call the 10 leading indicators from the conference board. And these leading indicators have a 100% chance of saying that we are going to go into a recession. Now, on the level of when, it's going to be in the same time frame, that April to May time frame. On the level of how severe this recession is going to be, it does come back and suggest at least that we'll be on par with 2000 to 2002 recession that we had. So it's not going to be maybe as bad as feared, but it is going to be prolonged. That's what this one is suggesting. So let's keep going. Let's look at some of the other data points out there. We have obviously the top 10 leading indicators that we've talked about. We've had the National Bureau of Economic Research and the credit cycle that we talked about. So when we take a look at the next one, this is a really big piece. Housing. Now, housing is a really big piece because a lot of our economy is in one way, shape, or form revolved around housing. Whether it's the building of new houses or apartment complexes, whether it's the renovation of it, the maintenance going behind the housing market with electricians and all of the employees that go into construction, to even places like Home Depot where we need to go for the goods. You see, a lot goes into housing, and so knowing where housing is going is actually a good indicator of where the economy in general is headed. So housing is a big piece of it. And what housing is starting to say is that we are going to be in a recession probably around May of 2023. See, that's what the data points start to show. And that's really what we're starting to look at here, that all of these indicators are starting to point to the same thing at the same time. Now, when it says how bad can we get, again, these are just thought processes. So we don't have to be bad or good with respect to a recession, but if we're looking at just housing in itself, it'll be pretty bad, is what the data is starting to show, that the slowdown in housing is going to be that pronounced. So we take a look at that, then we go into the last element that we were looking at here. This is really thought process of the housing in general. And then it really brings forward that around the country, and we start taking a look at new orders, manufacturing, all the different ways that not only for houses but for cars and autos or anything else that we need to produce. We start taking a look at where the production is coming from in this country, where we're importing from around the world as well. And one of them is the Philadelphia Fed. Now, what they do is they look at all new orders that are coming in. So as a company, you take a look at where all the new orders that you need to produce the goods that you have. And what those are really starting to say is that we're not buying a lot of new stuff. And I'm not talking about us as a consumer. I'm talking about us as the manufacturers. The manufacturers are not buying as many new parts, new raw goods to build from. And so when we're not buying that much in new goods, new parts, new raw goods, we're not going to produce as much. And if we don't produce as much, that is likely because of the fact that the demand is not there. And if the demand is not there, obviously that is pinpointing more and more that we have a slowdown that's starting to occur. And what this is saying is that the data is suggesting by May of 2023 that this will show that we are coming into a recession. And basically the severity here is really coming down to the fact that it's an unknown. You see, this has just started to really go negative and to turn into a point that we need to be looking at and worried about, but it doesn't have a data point yet as to how severe. So realistically speaking, when we take a look at where we're at and where we're going, of the 5 leading indicators that we could be looking at. The ones that, of some of them that I have mentioned here, 4 of those are saying that we have a recession on par with about 2000 to 2002. So that recession we're going to come back to, because that's a very vital piece of what we're going to be talking about today. But just know that the data points are showing a recession, that we need to be at least preparing for the fact that this may be a recession that is going to be run-of-the-mill, if not just a little worse. But this does not have to be on par with the recessions that we've known either. You see, every what we call recession is different, and the differences are what make it severe and feel like 2008, 2009 all over again, or just a normal recession that is just a part of our economic life. So just know that recessions are something that we don't need to fear, but we just need to be cognizant about. Let's jump into the second piece that we've been wanting to discuss on volatility. Now, volatility is something that when we take a look at the stock market in general, if we have a higher amount of volatility, that generally means that people are a little more unsure or fearful of where things are going. So the higher the amount of volatility, the greater likelihood that we have of prices actually going down. The lower the amount of volatility, the greater the likelihood that we have prices that are going to start heading up with the stock market. Now that's, again, a generality, so this has no way of predicting exactly which way we're going to go, but in general, if we have a high amount of volatility, that does indicate fear. So where are we at today? Where does this mean that we are going with our own stock market and where the expectations lie? Well, we need to take a look at where we are coming into right now. You see, this period of time that we're in right now is one of the highest volatility points in time in history. Now, when we take a look at what we call the greater kind of changes on a daily basis, we look at how many times in a yearly basis have we gone up or down by more than 1.5%. And what we're starting to see right now is that 1.5% is very significant, because that shows that we have huge movements that are starting to happen one way or another. And when we take a look at where we're at, we are in the third most volatile time period in the last 70 years. So when it feels like we have a lot of ups and downs, and it feels like one day we're all of a sudden going to have an incredible up day of 2-3%, is followed the next day by being down 2 or 3%, that right there is volatility. And yes, it is showing that we are at a higher point in time now than what we have been mostly in the last 70 years. So just keep in mind that when we find these volatile times, what that is showing is a heightened basic awareness of some fear that is out there. But that fear doesn't have to drive your decisions, but we have to know how to manage it. And one way right now that Wall Street in general has been trying to manage their fears is by really shortening up the trading. And so you have a lot of these traders that are out there, all of these computer programs that are trading are going away from 1 month, 2 months, 3 months calls that they're buying, which are stock options. And so basically they're leveraging up their bets on a magnitude that is 100 to 1. That is what a call option does. But instead of leveraging that bet up over the course of, say, 2 or 3 months, they're leveraging it up now in the magnitude of 1 day. So what happens is that you start seeing a lot of specific types of buying start coming in, and this buying can really start to push and propel us to that 1 day level. And so that really is part of this trading that's starting to happen that is different now than any time in history. And so much so that it's only cropped up in the last couple of months, this type of trading. Now there's obvious reasons why these companies, these computer programs are doing this, but just know that the heightened volatility does not indicate we are in incredibly good times of the stock market, but it also means just to be aware of where we're at. So when we talk about the recession, we talk about what's going on with the stock market, the heightened volatility that's out there, just be aware that we do not need to make rash decisions, but know that over time, this volatility has the ability to either affect us in a positive way or negative way, and we can make some small changes in your overall wealth plan and portfolio to take advantage of that. All right, moving right along, we've talked about the recessions, and recessions generally are because of the fact that we are not spending as much money. The earnings of companies are less today than what they were, and that really precedes the fact that revenues are down. A lot of these things are not happening in the times today as what they do happen in good times. Well, we want to talk about those earnings as well. And when we take a look at where we're at for earnings, right now, we're actually predicting decent earnings for 2023. But why? Well, historically, it's because of the fact that they take a look at where we have been and they put just a 2 or 3% growth rate on there, and that's where they predict of where we should be going. But also, what's different about today versus other times in history is a thought process that the Federal Reserve is basically not telling the truth. That they're not telling the truth, that they're going to have interest rates be higher for longer in order to curb the inflation. Now, we all know about inflation. We all know the problems of inflation, especially when you look at whether it's the gas pump or whether you look at food. And it's been really something lately to see the price of eggs starting to skyrocket. Like, all of these things are just what inflation looks like. If we have too much inflation, that's a really bad thing for the economy and for the world in general, for just us being able to sustain ourselves and to live. So what the Federal Reserve wants to do is lower inflation by curbing demand. So we already know demand is curbing, and we already are seeing the fact that inflation is starting to come down slightly. So what the stock market is thinking now, and this is not necessarily true, so just know that there is a lot that goes into this and the data points that we see, but basically what the stock market is thinking, that the Federal Reserve is done raising rates. And if that happens, what the stock market is also thinking is that we are one step closer to starting to lower rates and interest rates. Well, if we start doing that, that means money flows a little easier. That means that we are able to go out and buy the houses again. That means that we're able to buy the goods again, whether it's a new refrigerator or a new car. That we can afford these things more. And so that's the real thought process of where we're headed right now, is that we're done raising interest rates. That this coming February, when we basically will be raising interest rates most likely for the last time. And that'll be around 1/4% raise of the interest rates. But if that's not the case, if the Federal Reserve wants to raise more to curb inflation more, or if they do not cut interest rates, then everything that we know with respect to earnings actually may need to change. And instead of growing in earnings, what we're starting to see is it may contract, meaning go down in how much potential a company can earn. And if that's the case, then what that also shows is that the stock of that company may be too expensive right now, too high, and may have to come down. And if that happens across the board to a lot of different companies, then that is how the stock market starts to decline farther from here. So right now, the stock market is thinking that the Federal Reserve is done, but that may not necessarily be the case. So we need to keep an eye, and especially with Jay Powell, with what he's saying, because when we take a look at what he's saying, he right now is really saying that he wants to curb inflation at all cost. And he's going to throw politics aside, he's going to throw the stock market aside, and he's going to throw a lot of his very good friends aside that work in Wall Street just to make this happen. So we need to at least be cognizant that he may be telling the truth. And if that's the case, then earnings of companies are going to start coming down, which means the stock market in general may start to come down more. So up until this point, it really has not been great news that we are seeing, but we are in some people claiming a new bull market. For the last couple of months, we've had the stock market start to inch upward. And when we're taking a look at that, those things happen. And especially when we take a look at what happened through 2000 to the 2002 recession, we start to really see some really good data points of what that likely could mean for where we're at right now. So let's take a look at that. Alright, when we talk about 2000 to 2002, that has really been a point in time that we are now focusing on a lot. And the specific nature is because of the fact of not only the significance that had for the tech bubble being burst and a lot of the recessions that we saw, but also the ways that we lined up the quarters of recession, the quarters of GDP that we were seeing in that period of time as well. That's really correlating to today. Now, when we take a look at things here, in 2000 to 2002, we had well over 10 times, and if I remember correctly, it was almost 14 times that we had a very significant up move in the stock market. And we're talking between 20 and 30% moves in the stock market. And one of them was over 40% moves in the stock market in a very, very short period of time. Well, why that matters is because that was not the bottom. When we had those massive up moves in the stock market, that was not a bottom. What we called that was a bear market rally. And so what that means is that in this bear market, this time period that we are in a very big downturn of the stock market that's prolonged, we do have times that are going against it, that are not with the trend. And if the trend is down, not with the trend would be up. So we need to actually be aware of that right now, many people are starting to say that we are in a new environment for growth. We had a year in 2022 where the stock market did not grow well, the bond market was not doing well, but that changes. And this year is going to be our year, and you can start to see that in the stock market and all of the great things that are starting to crop up. But when we take a look at other environments, when we've been in these recessionary types of periods of time, that normally is not the case. And so when we take a look at 2000 and 2002, knowing that they had this many times where we had great up times in the market, but they were more of a great selling opportunity than a buying opportunity, that allows us to be at least really at least aware of where we're at today. Now, again, why this is important, and I actually skipped ahead because we were going to talk about the massive moves that were coming first, and the massive moves that we're seeing, we haven't seen yet, but we most likely will. And why this is something that I'm predicting is because of the fact that we have the monthly lines starting to come together. We have the weekly lines and the daily lines all starting to converge on each other. Now, what those lines are what we call moving averages. And that just talks about where price has been. So we look at whether it's 1 day, 1 week, 1 month, and we take a look at the time periods. So for a 1 day period of time, we may look at the last 200 trading days. Or for the last week, we look at the last 50 weeks. Or for the last month, we look at the last 5 to 50 months. We see those are massive trend lines, and if those are all converging at the same point in the same time, 100% of the time, that has historically meant that there's a big move that's going to happen. Now, it does not predict which way, up or down. But when we talk about the volatility that's already starting to crop up more and more, we talk about the fact that we are most likely in a recession or coming into a recession just based upon the data. When we start talking about the fact that we're starting to see earnings that have a potential to start coming down, the at least thought process is that we may have another move downward in the stock market. So again, this is not something that is a predictor, but this is just a thought process that you start to look at. And see, when we talk about protecting wealth, when we talk about growing the wealth and how we can do that in a tax-free basis, all of the things that we here at Alliance Wealth really start to work with, we want to know where the stock market is going and the thought process there, so we know how to direct the assets appropriately. And so we know that there most likely will be a massive move in one way, shape, or form coming. We know it's very likely that we will be going into a recession. We know it's very likely that earnings of stocks in the stock market may come down. But that also means that it's just a matter of making some small adjustments along the way that's going to really push that aside and maybe even have an avoidance of a lot of that pain in your overall portfolio just by making some small little tweaks today. So those are some of the things that we're starting to see with respect to the overall economy and the stock market. And I want to leave you with this. When we take a look at, again, where we're going and that 2000 to 2002 period of time, why we look at that is because of the fact that right now we are in what we call lead 4. That's the Alliance Wealth Economic Activity Stage 4, where we have a slowing of inflation. So this is more of a disinflation type feel. And we have a slowing of growth. Well, the only real other time period in history that had this back-to-back lead 4s, these categories that we're starting to see was 2000 to 2002. And so when we take a look at all of this data together, cumulatively, that's where we start to come up with our thought processes of where we're going. Now that, again, is something to take a look at your own portfolio and how to really be working with it correctly. But as you would like to at least have a second opinion on where your wealth is placed and how you can be making some small adjustments, feel free to reach out. We'd be more than welcome to talk through your overall wealth plan, your portfolio, and see if there's any adjustments that need to be made based upon what we're starting to see right now. Because you've made it this far in the video, I want to celebrate you. You see, most people start but don't finish talking about their wealth plan and implementing the details of their wealth plan. But since you are different, I want to offer you a special one-on-one consultation. And in this consultation, we are going to be looking at where you're at today, the details of where you're at, and then where you want to go in the future. And then we'll be talking about the gaps that potentially will exist and how we can be closing those gaps. Now that is the essence of this one-on-one consultation and the ways that it's going to be benefiting you to get and to hopefully help to improve the overall plan that you have in place, not only for how to create that impact, but how to most likely do that on a tax-free basis of how to be growing your wealth, transferring your wealth, as well as creating tax-free income. Now, all of that is part of this special one-on-one consultation that we are going to offer to you complimentary, just for clicking this link below. Once you click the link below, you will sign up for our special one-on-one consultation, and we'll be looking forward to talking with you and to help improve your overall wealth plan. For more tips and tricks on how you can be improving your overall wealth plan, I've hand-selected this video right here. I will see you there.